Let's just talk about how business is. Can I just start with you?
Sure.
How are things going? It's obviously equity world, is volatile.
Okay,
Not volatile,
so
but
let me
how's
summarise
your
it.
business going?
Yeah, I'd be delighted to do. That's what I like about this Friday night show, because we just chat.
Yeah,
we just chat.
So
business,
very healthy.
The stock market is a difficult place to invest at the moment. We'll talk about that as the show progresses.
Yep.
And I say that because rubbish is going up, and
Yep.
we don't invest in rubbish, so that makes it hard.
Yep.
We can't find a great deal of value except for the floats. And there's some really good floats. And the reason why, I think, normally when you've got an informed seller, usually private equity, meeting with an uninformed buyer, us, the best deal is usually done by the vendor. So, but in some cases, in some of the floats, you've got private equity who really stuffed it up last time and burnt a lot of people, and so they're upset. But they've got a pipeline of things they've got to sell. So these early floats that are coming on, they've got to price them really keenly so people have an appetite again.
Because that's completely contrary to their normal behaviour, because that was one of the things I was going to ask both of you.
Absolutely. You don't go to a private equity company and say, look, I can do this for 30 times earnings. The private equity vendor is not going to be saying, no, look, I want you to do it at 20 or I want you to do it at 15.
And then you count how many fingers was it?
Yeah, that's right.
I'm okay, and you can get out.
Is my wallet still here? Yeah, I've still got my wallet. Yeah.
Because I was thinking about that idea that I was reading some of the Goldman's paper about the level of money going into the equity market, and it's all that retail money, it's big, bold headlines, retail money, and that makes me a bit nervous.
Yes.
And then it's 16 IPOs will come out between now and the end of the year, and I think IPO meets retail money meets disaster.
Well,
so
for the reasons I've just described,
no,
I think private equity is being a little bit generous in some of these floats, believe it or not. Not all of them, but
Chris,
some of them.
There's a couple of people that are watching this show, so are you prepared to go on the record as what you think is the generous ones in terms of these listings that you think, like is Channel 9 a generous IPO?
Oh, look,
I used to work
I think we've seen the papers talking about Vader, for example. That's been, there's been overwhelming demand for that float, and I think that's because it's been priced very keenly.
Also a very good business.
Yeah, and it's a great business. It's a capital light business. Credit rating. Yeah. Credit rating agency. So you're a bank, someone wants to borrow money from you, you ring up Vader and find out what their credit rating is like.
How can we help you?
Hi, Mark. Look, I'd like to ask Roger, on Mike McCarthy, this time, in June last year, I bought 2,000 Macquarie at 24.50. Look, the result today didn't seem to be too bad, but what I'm asking about, is it correct? One share in the Sydney Airport, and Mark, what would you do? Would you sell those shares and buy the Sydney Airport bonds, or keep them knowing that they are loaded with debt? Thanks, fellas.
So you aware of what's happened with Sydney Airport, what Macquarie Bank have announced with Sydney Airport? So they own Sydney Airport at a percentage, I think it's 18%.
I remember when they sold it.
Yeah, so they're going to do an in-specie trade. They're going to give the shares that they have, or they're going to create extra shares in Sydney Airport. And so the Sydney Airport equity was sold off on the basis that there was more shares around, but basically the fund managers will ultimately just sell it straight away because of liquidity issues and because of they want to own Macquarie Bank as opposed to Sydney Airport. So did you have any chance to have a thought about that?
Well, the only issue is what proportion of the fund managers are index tracking, and what proportion of their portfolio can be in the airport security. And if they can't, then they'll sell it and that'll push it down. But it sells off in anticipation of that.
So the IPOs. A couple of minutes before we go to the next break.
Very quickly. Look, you mentioned earlier, you just talked briefly about how the change in dividend policy of Australian companies, the increase in the payout ratio, and the payment of more dividend, and what that means. And let me talk to you about what it does do to equity valuations. And I don't mean prices, I mean valuations. When a company like ANZ this week increases its payout ratio, and they've gone to almost 70% now, the shares have been going up. And the shares go up because everyone's chasing yield. So people see the higher dividend yield, they look at what they're getting in their term deposit and they think, gee, that's better. They bid the share price up. The problem is the value of the business is now lower.
Because you're not
the
getting
valuation is lower. Yeah, because you've got less money being retained and compounded at 15, 16%, 15.3% in the case of the ANZ. You've got more money being paid out to people, and so the value of that business is actually less. So you've got this odd situation where the share price has gone up, but the valuation has not gone up as much or has even gone down, and that increases the risk.
So, Roger, are you...
So let's start a conversation about bubbles and property, right? Because I think people are interested
really
in that.
Important. At the moment, that's real. You know, that is just so
I think the seeds of a bubble are germinating, but I think we're some way off a bubble. And let me read this. This is from the book by John Kenneth Galbraith, who is a Canadian US economist and diplomat, and he wrote a book called The Great Crash. At some point in a boom, all aspects of property ownership become irrelevant except the prospect for an early rise in price. Income from the property or enjoyment of its use or even its long-run worth is now academic. What is important is that tomorrow or next week, market values will rise, as they did yesterday or last week, and a profit can be realised. So when people throw fundamentals to the wind, then you start getting a bubble. Now, let me just say this: in Mossman 2 weeks ago, I think it was Rain and Horn sold a block of flats in Mossman for there was a one three bedder, two bedders, two one bedders.
A block of flats, okay.
Block of flats, okay. It sold in 2009 at the depths of the GFC for 2.9 million, and the buyer sold it last week, I think, for $3.52 million. Gross rent, $135,000 gross.
Really?
Gross rent was $135,000. Now, if you take away anyone, you got to pay your maintenance, you got to pay tax, then you've got to pay to the real estate agent the management fees. But if anyone was borrowing money, even if they borrowed 50%, and most people borrow more than that, but even if they borrowed 50%, at 5%, you're making no income return on that at all. Yeah. None at all. So you are speculating. You are speculating on capital gains.
So this is Brian from Gladstone. Hello, Brian. How are you?
Good, thanks, mate. Just can I get the opinion of the boys on Australian stocks with majority international earnings in large markets compared to Australian stocks like some of the local banks where the majority of their earnings is within Australia. The only other comment I'd like to say is Helen will not be Ellen.
Okay. All right, so very quickly, the issue is not whether the company earns its profits in Australia or overseas. The question to ask is it a great quality business? If you believe that Glenn Stevens is going to be able to jawbone the Australian dollar lower, and then you'd be delighted to own great quality business that's earning US dollars. So a CSL maybe. If you don't believe the analysts and you think the long-term prospects for Cochlear are going to be great, fine. If you think interest rates in the US are going to go up and the Australian dollar is going to drop, then maybe QBE is an option as well. And so you would look at that. But if you don't believe that the Australian dollar is going to drop, and then it doesn't really matter. You look for great quality businesses irrespective of where they earn their revenue.
Great question. Sorry, you wanted to say.
All right, so what I wanted to say, just to your point, and I think this is really important for Australian investors, because if you read, other than your article, if you read everyone else's columns, they're talking about tapering and the dangers of tapering and that sort of thing. But if Yellen takes the chair and she's no longer vice chair, then the woman who may take her place is a woman named as vice chair, is Christina Roma. Now, Christina Roma recently gave a talk at Johns Hopkins University, and only on October the 25th, so we're just talking late last week. And what she said was very, very interesting, because what she's talking about is this regime change. So switching from inflation to nominal GDP or GNP is a regime shift.
Absolutely.
And they've looked at Abe, who came out and basically sacked the governor and two others, and said, right, well, we're getting rid of this deflation situation. This is what we're going to do. They then looked at Mario Draghi. Mario Draghi, the most famous 7 words.
I will do
whatever it takes to save the euro.
And he did.
And so they're talking.
What's Roma saying?
So Roma's come out. Really interesting.
Christina Roma was on the Obama Economic Committee. She was the chief architect in 2008. So
Correct.
She's instrumental in coming up with the strategy that was but we'll give all the money to the banks, and we'll look after the Main Street later. So Wall Street got looked after.
So, and this brings us back to bubbles, okay? It brings us back to bubbles. I'll quote what she said last week at her lecture. Switching to this new target would have some important benefits. In the near term, it would be a regime shift. It would unquestionably shake up expectations. Since we're currently very far below nominal GDP path based on normal growth and inflation from before the crisis, it would likely raise expectations of growth and help spur faster recovery. Now, I know how scary that sounds, but listen to this. Today, I worry, and this is somebody who could be Vice Chair of the Federal Reserve, today I worry that guilt over letting asset prices reach the stratosphere in 2006 and 2007 has made some policymakers irrationally afraid of bubbles. As a result, they focus on the slim chance that another bubble may be brewing rather than on the problems we now face.
It's absurd.
Isn't that scary?
You first.
Oh, all right, very quickly.
Got 2 minutes.
So we've inflated this bubble.
Yep.
And there's a risk of greater inflation. Out of the top 100 companies, I can find 4 stocks that are cheap.
And they are?
Now, they are Fortescue Metals,
Really?
JB Hi-Fi,
You always buy that.
JB Hi-Fi, Orica, and Leighton's, and you wouldn't touch those. Given that there's 96
Leighton's is just extraordinary.
96 of the top 100 companies are expensive, that tells me the market is at very real risk of falling, and if it doesn't fall, there's not much risk of it going up a lot.
Okay.